Welcome to the Roetzel HealthLaw HotSpot. HealthLaw HotSpot is a podcast for physicians and health professionals that covers the legal issues and trends that affect the healthcare industry.
Hi, everyone. Welcome to the HealthLaw HotSpot. I'm Ericka Adler, shareholder at Roetzel and David, and leader of the healthcare practice. Today, we're going to be talking about private equity investment in physician practices and other types of healthcare ventures. And I'd love to introduce you to our special guest today. Craig Caselli is the founder and CEO of Hill Advisors, and he has over 20 years of M&A experience in healthcare. And of course, my favorite co-host, David Hochman. He's also a shareholder at Roetzel and David, part of the healthcare practice and head of our Chicago office. So Craig, thank you so much for joining us today. We're happy to have you.
Thanks for having me.
And I love this topic because today, especially, so many of our physician practice clients and other types of clients that we have are in the midst of selling to private equity. And so maybe you can give us a little bit of insight as to what you're seeing right now in the healthcare industry in terms of private equity activity, and then we can jump into some more detailed questions.
Absolutely. So it's great to be here, and I appreciate everybody taking the time. We've seen a steady build in the interest of private equity firms in investing in physician practices. And if we compare partner transitions to even 10 years ago in a lot of specialties where the only option was to sell to a younger partner, typically for a predetermined valuation. The emergence and growth of private equity in a number of specialties has really created a lot of new opportunities for physicians to exit their practices and achieve greater levels of liquidity, as well as to fuel growth and grow businesses to a level that they may not have been able to achieve on their own. So it's very exciting. We're seeing it across all aspects of healthcare, and within practices specifically, we've seen growth from kind of a few core, more retail-oriented specialties, dermatology, urgent care, eye care, dentistry, to groups that are reaching further into less traditional aspects, at least from an investment standpoint. We're seeing private equity enter women's health, urology, GI, pulling together multi-specialty clinic groups, kind of bridging GP to some of the various GP subspecialties. So it's really exciting. There's a lot of money flowing in. There's a lot for doctors to consider when it's time to pursue an exit.
Are these groups interested in any size of practice, or should you really not even be thinking about it unless you're, a certain size group or a certain amount of revenue in your practice?
Well, that depends on how you want to view a private equity transaction. So when a private equity firm enters a new specialty for the first time, they're making what's called a platform investment. That first business they invest in or buy is their platform. They're going to use that to grow. And onto that platform, they will add several additional acquired practices. If you want to be a platform, you typically need to have at least 2 to 5 million of EBITDA, earnings before interest, tax, depreciation, and amortization, for some of the smaller private equity firms to begin to show some interest. And larger private equity firms may not invest until a group has, 10 or even 20 million of earnings. However, if for an add-on acquisition, you'll see some groups that may add on single practices, 1 to 2 doctors, single location. They're a nice, complementary fit due to the geography or the payer mix or the service mix, and it's part of how they're going to grow that business. So and when you think about it that way, there's much less of a size constraint on a potential target.
So Craig, in private equity and healthcare, is it more typical for the private equity investors to be in this, to operate on a long-term basis, these practices, as opposed to your private equity wants to buy a business, ramp it up 3 to 5 years, then sell it to someone else?
Traditionally, and the vast majority will be focused on that 5-ish year hold period. We talk about the hold periods in terms of a 5-year average. They want to make an investment. They want to grow it rapidly over a roughly 5-year period of time. They want to reach a point at which they can triple their invested capital. And then they will look to bring in a new majority owner for the business. Could be another private equity firm, could be a strategic operator in the space. You will see some that have longer hold periods. Typically, they are either family offices where you'll have a high net worth individual or individuals who are investing their own capital and are not beholden to any additional outside investors who can take a longer term view. Or occasionally you'll find some other unique situations that will lead a private equity firm to hold an investment for a longer period of time. But from a macro perspective, when a private equity firm raises money, they typically promise to return all of their capital to their investors after 10 years. So in order to do that, they can't own these businesses for more than roughly 5 years in order to buy them, grow them, exit them, and then return capital to their own investors.
Oh, I think that's interesting. And one of the things that you mentioned that kind of sparks a question to me is, we have this idea of private equity companies as being, large, experienced, knowledgeable about being private equity. But I've done some deals lately, and I don't want to even call necessarily the buyers private equity, but people who have money and decided to come together and kind of compete with private equity and start buying up practices. And so what kind of private equity partner is really the right partner for a physician practice if they're looking to sell? Are they better with the traditional that have experience? Should they be that first one for a private equity company to take on? Or should they work with people who aren't traditional but promise to be a friendlier alternative, which I think is kind of how they're selling themselves?
Yeah, no, it's a great question, Ericka. And one of the things that we talk with our clients about very early on in the process is that getting the money is the easy part. Anybody is willing to write a check, and healthcare has been so successful. It's a very secure place to invest capital because healthcare, as an industry, rarely declines. It's a huge part of our GDP. It's a growing market, especially areas of healthcare that focus on an aging population as people are living longer and spending more on their health and their well-being. It's proven to be a very successful bet. And so you're finding more and more people that want to invest in healthcare. So the tricky part is finding somebody who will write a check to measure it with everybody else, who is also the best fit for the sellers, for the legacy that they're trying to preserve, for the vision that they have for the future. That, something as simple as the personalities meshing, as, these deals tend to be more, marriages than just, the sale of your house where you walk out, somebody else walks in, and you never see them in person. So there has to be that personality and cultural fit in order to drive success. There are a few ways that we can distinguish the private equity firms. One that you hit on is certainly their healthcare experience. While I'm not opposed to giving somebody their first shot at anything new, if the situation warrants, by and large, we like to see investors who have a lot of experience in multi-site healthcare investing in our clients. They may not have the exact same specialty or regional experience. They may be investing in a dermatology practice today for the first time, but they've owned ophthalmology, they've owned dentistry, they've owned veterinary. They've shown their ability to grow multi-office physician practices over an extensive period of time and have one successful exit over the next. That suggests that they can replicate that in the next specialty, as opposed to somebody who's invested in manufacturing or business services and thinks a business is a business is a business and just wants to jump into healthcare because they've seen other people successful in healthcare. The other line to draw is between those investment firms that have committed capital behind them and those that are looking to find a company to invest in and then still have to go raise the capital to complete the deal. And, when you have what I would call a real private equity investor, which is, a firm that is managing a fund of committed capital, you know that they have the capital available to deploy. So your certainty of close is much higher. When you have what we call an independent sponsor who doesn't manage their own money and has to bring in outside investors each time on a one-off basis, it's much tougher to get the deal done. Oftentimes, they may not be as competitive in the processes either, but by and large, your certainty of close is just a little bit lower because they don't have direct control over the capital.
Right. So other than money, which is obviously every doctor is like, what are you willing to give me for my practice, right? And we'll talk more about how they come up with that number, but, what is a mistake that a practice makes, if they're not also asking, certain questions. So we got the money. It sounds like a great number, but that doesn't mean it's a great fit. What are some
Right.
key questions that practices should also be asking in addition to how much money they can get?
Well, I think just on the money piece, there's a lot more to the deal itself than just the sticker price. So, very rarely do you see practices being sold to private equity and have 100% of the valuation transferred in cash paid at the closing. Usually the doctors are retaining some equity in the business going forward. They may transfer the equity from their individual practices up to the holding company level where they're owning the same shares as the private equity investors, but they're still shareholders in that business. There may also be some other contingent payments that follow in future years, perhaps based on hitting performance milestones. So just on the deal itself, doctors need to look beyond the sticker price and really understand, all of the other terms of the deal. If we look at the non-financials, doctors should always ask for references. A successful private equity firm should be able to introduce them to other founders who they bought businesses from, who had a good run with them, that can tell, a more objective story about what it was like to partner with that PE firm. The other question that I think always needs to be asked is around why this business, why this industry or this specialty? What's your angle? You want to invest in my GI practice in Minneapolis, Minnesota. Why a GI practice in Minneapolis, Minnesota? How do you plan to grow this business? That answer can be very telling as to whether they're just casting a wide net and bidding on hundreds upon hundreds of deals and playing a numbers game, or they have a clearly formed thesis that they can articulate about why this specialty, why this geography, what their vision is for growing, the invested, the acquired company.
Right. I think those are great comments. And it's interesting because your perspective and how you answer that question is a little different than the things that I look for. So in addition to the purchase price and how it's getting paid, how long they have to stay before they get it, what is the commitment? A doctor who's retiring and really hope to be done in 2 years may be out of luck if they're really looking for a 5-year commitment, which is pretty common in what I'm seeing locally in the market, 5 years. So if you're thinking of retiring, this may not be the way to go. Are you going to retain all our staff, right? So often the staff means a lot to a doctor who's selling, they've been together many years. So there's a lot of intangibles. And David, I guess, what other kinds of things do you feel that your clients care about? I mean, obviously money is the driving and all that other stuff sometimes goes out the door if the price is right? But what other kinds of things do you think they need to look for?
Well, I think that you have, the question of how long do I have to continue to work? And then the question then becomes, I'm going to sell my practice for X dollars. But the private equity firm is interested in making a profit, and money that I was otherwise taking out as compensation is now probably not going to be there because the private equity owner is going to want to have that for its investors. So the question becomes, am I going to be satisfied with the compensation I'm going to be earning going forward? And I think one offset for that is that you keep some equity in the deal. So you roll over part of your investment and you remain as an owner of the practice. There are some private equity investors that in some specialties, I'm not quite certain that I've understood the economics, hospital-based groups. An anesthesia group seems like it's a difficult private equity investment because the anesthesia group, they're at the pleasure of the hospital. Those contracts go for 2 or 3 years, and then they can be replaced literally overnight. And
I guess you stay away from those, right, Craig?
Well, yeah, but I guess it goes to the question, Craig, of how do you determine the multiple that a practice is a particular specialty is likely to generate? Dermatology versus anesthesia or pathology.
Certainly. I want to just circle back to something that you said before this, David, and then I'll jump in about the economics for the doctor, post-sale, because you're right. All of the profits distributions that partners are taking go away. That's really what forms the profit on which we're valuing the business and ultimately profit for the new enterprise going forward, not pay to the individual partners. One of the most challenging scenarios that we face on the front end and that most partnerships will face are when you have a multi-generational partnership, within a larger practice, because the incentives are very different for the 60-year-old partner than they are for the 40-year-old partner. If I'm 60 and I'm selling this business in the next, or I'm retiring, I should say, and selling my shares in the next couple of businesses, in the next couple of years, no matter what happens, I have a lot of upside in the private equity scenario. The way that they're going to value the business, the way that they're going to pay me for my shares, the way that my rollover equity can grow, is massive for me. If I'm 40, I have 20 to 30 years of partner income that I am giving up to go back to associate compensation. The math may not look so good. Now, the rollover equity and certain other aspects of that deal, could offset that, but it's always a huge concern in the younger partners, and why you'll start to see some rifts in these partnerships, when you have such a gap in age from, senior partners to junior partners. To your point about value, there are a few key drivers of the valuation across, physician practices. The earnings is one. There are certain tiers of earnings. If you move from, one tier to another, the overall valuation range is going to, increase. But beyond that, what investors really look at is the stability and the predictability of these earnings. So, comparing a dermatology practice to, your anesthesia example, if there's a greater risk of loss in that anesthesia group because the contract can be canceled, at the whim of the hospital, then, that's an additional risk factor that the investor has to, account for. And perhaps that's either, a lower valuation placed on that group, or, more cash that's paid over time as opposed to at closing, to basically demonstrate to the group, hey, look, if this contract is renewed, we'll release the rest of the purchase price, but until it gets renewed, here's what the business is worth, and that's all we can pay. Now, if you have a very large anesthesia group, practicing at multiple hospital systems across multiple markets, you have more insulation against that than if you're a small couple doctor group, with just one, hospital customer. In that case, you're probably going to get a better valuation selling to that hospital system than you may to, private equity backed anesthesia group. But, there's some other factors that really get into the stability and the predictability of the cash flows. How good a job does the practice do at retaining doctors? Because doctor retention is stability, it is growth. Another big driver of value for, any type of practice is what we call organic growth, or to use a retail term, same store sales growth. So if we look at Office A, how does Office A do last year compared to this year compared to next year? Can we show that office on its own is steadily growing? That's usually linked hand in hand with doctor retention, because if you have the same doctor there, year in and year out, you're probably going to see, some natural growth coming out of that office. It's easy to grow by acquisition. That's another component that private equity investors will value when they're looking at larger group practices. Are they able to either use a de novo model and open new offices and continue growing that way, or have they been successful making acquisitions, integrating acquired practices? That leads to that more explosive growth. But also, if we stop making acquisitions, can the core business continue to grow on its own? And businesses that are flat or declining can still be acquired, but they'll fetch a lower valuation than businesses that are growing and can check both the organic and inorganic growth boxes.
Right. And, one of the things, obviously private equity seems to have a lot more freedom to set the price than if you're selling to a healthcare system, a hospital, right? What are some of the multiples that you're seeing? I see a wide range, but I certainly see a much higher number being offered by private equity than hospitals can possibly compete with from a regulatory standpoint.
Yeah, a lot of hospital deals tend to be very rich employment contracts and, very conservative valuations, and private equity tends to be, the opposite. If we're talking about a successful multi-office healthcare group that checks a lot of these boxes around doctor retention, a good culture, some semblance of a management team in place beyond just the partners who are practicing full-time, organic and inorganic growth, et cetera. Upper single digits to lower double digits multiples are very, very common. If you're in the 1 to 3 million of EBITDA range, you can expect a kind of mid to upper single digits. Once you cross 5 million of EBITDA, you start to get into that, low double digits, at least kind of an 8 to 12 times range, depending on the specialty and some other factors. And once you eclipse that 10 million of EBITDA mark, you can expect, a 10 plus multiple from just about anybody who's going to, become a serious contender for the business.
One of the challenges that I have when I help my practices sell, and, we've done a lot of transactions this year, so it's come up quite a bit, is you might have just one or two actual owners, and yet you have a lot of important physicians in the practice who generate a lot of the revenue, and they're not getting part of that purchase price because they don't own the company.
Right.
So one of the things we really struggle with is, and the EBITDA or the earnout at the end of the day could be tied to them staying for a certain amount of time, signing a long-term contract, helping the practice achieve certain goals that are set by the buyer. How do you typically see that being handled? How do you keep those doctors who aren't getting the purchase price engaged? How do you get them to sign those contracts? What are some typical strategies? Because I think a lot of people hold off on selling because they're afraid they won't be able to get the non-owner doctors to go along with it.
Yeah, so the first thing we want to do is understand why there hasn't been a broader partnership created in the past. Are these doctors that just enjoy being associates and have no interest in being owners? Or are these owners that have gotten away with not offering partnership to, some great associates and perhaps seen some additional turnover, as a result? We also want to understand, how are these associate doctors compensated? And, are they in a position where they're already paid above market, so they're not going to leave? Because, a buyer coming in is not likely to mess with any compensation for any non-owner. So if these associates are paid above market, the buyer, if they're really interested in the business, they're going to maintain that compensation, which tells me there's a lower likelihood that those associates are going to leave just as a result of the transaction. Now, that being said, there are two strategies that we'll commonly deploy to ensure that the associates play ball and sign the employment agreements and live them out. One, it's becoming increasingly common that once private equity comes in, they create some sort of associate path to partnership. That partnership could exist at the office level, where it's a joint venture between the holding company and the doctor in each individual office, and the doctor has access to some portion of distributions out of that individual office. It's a nice way for them to supplement their annual income. Or, it could be purchasing stock that sits in the holding company alongside everybody else. And then, they have participation in the next exit and, that quote unquote second bite of the apple that people like to talk about when they talk about private equity deals. The other thing that we'll recommend is when there are earnouts at play, that the selling partners share in the proceeds from the earnout with the associate doctors. Be very transparent. We have to hit this goal. There's this much money on the line. You get this, and you get this, and you get this if we hit this goal, and you're here and you've helped us achieve that goal. And so that can be a nice insurance policy, because no matter what anybody says, everybody's motivated by money. If you dangle that carrot, people will work toward that goal, and the business will be better as a result.
Right. Absolutely.
Yeah.
I think, that's what we have found, definitely. Although, unfortunately, sometimes if you lose one doctor, but the others stay, you may not be able to hit the overall target. So, or if somebody, of course, dies or becomes disabled, the whole thing can go downhill, but that's a risk, right? So they're sharing the risk with everyone.
It is. In a perfect world, we wouldn't have earnouts, but they're there to cover uncertainty, and they're there to account for embedded growth that hasn't been realized. And so, there are, and they're not all created equal. I think it's a bigger point. I've seen earnouts that I am strongly in favor of our clients accepting, because they're true rewards for growth that they haven't realized yet, but are confident they can hit. And I've seen earnouts that are in place because it's a buyer trying to take advantage of a seller, and don't make any sense whatsoever, and will generally steer them in a different direction.
Right. Great. All right, David, any final questions for Craig?
No, Craig, I think that, to talk about your comments about the multi-generational practice, those are very tough transactions because of just everybody's got a different perspective on what they want to do. and also about the practice with a lot of associates and few owners. So I've had the occasion to been there, done that, and they're difficult transactions because you have sometimes the associates now have the bit in their teeth, and they want to actually end up getting more than is reasonable to pay. But I think your idea about trying to build a mechanism that they have a path to ownership is a great idea, and not all private equity buyers are willing to do that.
Right.
They want to push it off on the seller to go take part of the sales price and make the associates happy so that they will continue to stay.
Yeah, a client of ours
you had are really good.
Thanks. Yeah, a client of ours once said, you can have a lot of mediocre to good doctors if all you recruit are associates who just want to be associates forever. If you want great doctors, you have to give them some pathway to ownership, or they're going to leave, because the great ones want to own, want to have some bigger stake in the group, and the investment community is starting to wisen up to that fact too.
Well, that's a good final thought. Anything else you want to add?
Thank you guys for inviting me on here. This was a lot of fun. And, hopefully I'll be invited back again sometime in the future.
Absolutely. There's so much we could talk about on this topic.
That's great.
Agreed.
Thanks for coming. Well, thanks everyone for joining us on the Health Law Hotspot. Remember, you can check out our other podcasts, and you can also check out more about our firm at ralaw.com. And of course, you can check out Caber Hill Advisors and Craig Caselli, who we thank very much for joining us today. Thanks. We'll see you next time.
Use of the Roetzel HealthLaw HotSpot does not create an attorney-client relationship between you and the firm or any of its attorneys. The Roetzel HealthLaw HotSpot should not be used as a substitute for competent legal advice, and you should contact an attorney in your state about any legal needs or questions you may have.